Good morning, everybody. This is Dan with Theta Trend. Today is Tuesday, December 9th, 2014. It's about quarter after 5 a.m. here, and we are in Mountain Time. The market's open here at 7:30 a.m., so we're about 2 hours or so before the market's open. I wanted to do two things this morning. First, I wanted to talk about the naked put I put a video up on Sunday about, and then I also just wanted to do a quick recap on the IWM Butterfly because we're moving into expiration. I think we're actually getting within 10 days here now or so. And I just wanted to talk about that position and a couple of adjustments that I might use as we go into expiration just to sit in the position longer with a little less risk. So really briefly, on Sunday, I put up a video talking about selling a naked put in gold. We had a signal triggered for the P theta system, which means on the weekly chart, which we can go take a look at real fast. On the weekly chart, we had hit the parabolic SAR, and that's a trigger to get long. And the P theta system sells naked puts. So I was looking for a naked put to sell, which I did sell down at 101. So I sold a February 101 for 50 cents. And yesterday we got a close here up above the 10-week moving average on the weekly chart. And if we go back to the daily, that also corresponds with the 50-day moving average. And what we saw is we saw price gap open higher, traded down throughout the morning. I sold a put, and I got lucky because gold traded back up higher and closed above the 50-day moving average. You know, that moving average is still declining, and anything can happen, but I'm just following the system. If you want, we can hop over here to the Analyze tab real quickly. So I just have short 1 gold Feb 15 101 put at 50 cents. That's all there is to say about it. It has a couple dollars open profit right now of about, let's call it $7.50 or something. So that's good. It's always nice to sell something and have the market go in your direction. Now what I'd like to do is I'd like to go ahead and take a look at the Russell 2000 IWM. So yesterday, the Russell 2000, and actually let's go ahead and move down to a 65-minute chart. So yesterday, the Russell 2000 opened a little bit lower. It pushed way higher up into the 118s. And I think where did it top out? It topped out around 118.41. And so when I did this, I was kind of looking at it because this is right around my adjustment point, around 118 quarter, 118 half, somewhere in there. And I was starting to not feel very good about things because obviously it was coming under pressure again. And then quickly the Russell sold off. So what we have here on the shorter term time frame is now we have a violation of this higher low. So we had this pattern of higher highs and higher lows on a short term time frame, right? There's a high, there's a higher high, here's a higher low. Yet again, we got another higher high right in here, and then boom, we broke down and violated this. So what I like about this is it sort of confirms my feeling that we're in a little bit of a sideways market here with some chop. And what I'm hoping is that we stay either sideways to slightly more bearish, and we just stay in that pattern for a couple of days, and that enables me to sneak out of the trade with a little bit of extra money. So let's go over and look at the IWM position, just so we know what we're dealing with. So I have two trades open in IWM right now. I have the December put butterfly, and then I also have January put butterfly. And what I have selected right now is just the December position, and down here, these are all adjustments that have been made along the way. And this was traded during during November when the Russell was racing higher. So there were quite a few adjustments, and that's why it looks like something of a mess in here. And down at the bottom here, I just have a couple of other things that I've been looking at, this vertical, and this condor. These were different adjustments I was considering for the positions I have open. So let's go back up here. So we have this December position open, and the Russell yesterday closed at 116.22. In the pre-market here, it's trading at 115.92, so we're down about another 30 cents or so. That's good for me because we're short delta, short gamma, and positive theta. And so my sweet spot is somewhere down in here, like around 115 or so, something like that. So we're in a nice position. The thing that is bad about this is the gamma. And the reason I say that is if we get another move back up, for some reason my thinkorswim got slow there. If we get another move back up, very quickly this profit comes out. So we're sitting on an open profit of what, $180 or something. We run right up to 117. Boom, we lose $80. And so for a non-directional trade, that isn't great. There's a lot of gamma in here, and the profit can evaporate pretty quickly if price is not moving in our favor. It's nice to see here, the futures are trading lower. TF is the Russell 2000. It's off 4 points or so. So one of the things we could look to do is we could say, okay, well, we've got all this. We've got the short delta, the short gamma. How can we get rid of some of that? And one of the things that we could do is we could take off one of the long puts up here and move it down lower. So what I was looking at is selling out the 122 that I'm long. You can see that right here, it flattens out, and moving that down to 118. Well, if we were to do that, boom, all of a sudden, delta gets smacked way down. Gamma doesn't change a whole bunch, but the delta gets cut quite a bit. And theta goes, I forget where it was now. It was at 21, 22. Goes from there down to 17 or something, so not horrible. But if we just look at this, the shape of this curve and also the upside risk, our max upside risk drops down to 130. This is sort of a nice adjustment. What we give up, if we look at this, is a little bit of profit, I think, and then also some, if we continue moving to the downside, this is not great, and we have a lot of risk down here. So if we wanted to shore up some of that downside risk, we could also take off the 106, which is down here, and move that up. So essentially what we're doing on the trade is we're sort of choking it up. We're moving the long options in as we get closer to expiration, and that mitigates some of the delta and gamma risk and also allows us to stay in the trade more comfortably. So if we were to do something like that, move the 106 to the 110, that's going to cost us 17 cents. Suddenly then we're looking at something like this. We've really decreased the max risk on the downside. The upside has, it's 147, so it's still better than it was. But the range of profit gets a little narrower as we go into expiration. So I'm not sure if I will make either of those adjustments. I'm feeling like the one that makes more sense for me right now, based on my comfort level and things like that, is this one here, to move the 122 down to the 118. I could also be a little less aggressive and just say, instead of the 118, move it to 120 or something like that, just because it gives us a nicer T+0 line. So we'll see what happens this morning. And really quickly, let's go ahead. We can take a look at the January butterfly as well. This position has been significantly easier to trade than the December butterfly. Right now, it's sitting directly in the middle of the thing. It has an open profit of about $25. There's really nothing to do. For those of you who follow Mark Sebastian on the Option Pit blog, he talks about an adjustment called the reverse Harvey. And what the reverse Harvey does is it sells out these long wings, like at the 111, 121, and it moves them in. And when you do that, what you're doing is you're decreasing the risk. So what I was doing down here is I said, okay, let's take a look at what happens if we sell out the 121, move it to 118, and then sell out the 111 and move it to 114. So we've been in this trade for a couple of days. We have an open profit. We're sitting right in the middle. Things are going our way. How can we take some of the risk off the table? And before we make this adjustment, let's just take note of these two levels. 112.20 is our expiration break even on the downside, and 119.76 is expiration break even on the upside. If we were to expire right here, we'd be looking at a max profit of about 375 or so. I'm just roughing it out. So let's go ahead and put this adjustment on. And what happens to the position? Okay, our max profit at expiration becomes 196. So we give up a lot of potential profit in here. But what happens? If you notice here on the right, we're down to zero. We have no risk in this trade. The most that we can lose in it is $1. Or we make $1 in it automatically. So the most we would lose is the cost of commissions to get in and out. But this is something to take note of. This 112.20 was our previous expiration break even, and on the upside it was 119.76. So we're choking those way in. So to make any sort of real money on this trade, we really need to be between, honestly, 115 and 117. So we give up the range of profit, but we take all of the risk off the table. I thought that was sort of an interesting thing to take a look at. At any rate, thanks for watching. Have a great day of trading. And if you have any questions, feel free to post them on the blog or send me an email, info@thetatrend.com.